Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Bryan Hancock, and he is the founder of the Texas Freedom Fund. Bryan is a trusted leader in private equity, real estate development, and capital syndication. With over 20 years of hands-on experience managing real estate and construction projects, Bryan has also built and led multiple investment firms specializing in urban infill, energy, alternative assets, delivering an average of 35% ROI at project level. Pretty impressive, Bryan.
Oh, thanks. Yeah, it's been a lot of work. Appreciate you having me on the show, Gary.
Sure. So, Bryan, give us your background. What got you into, the wanting to start the Texas Freedom Fund and kind of the different investment projects you've gotten into over time?
Sure. Yeah, I guess it depends on how far you want to go back, but I guess we could start as a teenager, my parents always owned rental properties. So I kind of grew up with tenants and toilets and helping my dad reno the properties and things like that. So that's kind of how I got the bug. My dad actually gave me a copy of the Rich Dad Poor Dad book in my youth. So learning the cash flow game and all that. But I went to the engineering school here in Austin. I'm a Longhorn. I don't know if that's a good thing or a bad thing. Depends on who's watching. But so I have a technical background. I've been all throughout corporate America, IBM, Lockheed Martin, lots of big companies like that, Dell, other ones. But throughout that whole time, I've been also a real estate developer. So I kind of caught the bug when I was young, but in and around entrepreneurial activities, but most of the activities have been in the real estate space. So here in Austin, the fashionable thing to do, kind of in like the 2010, right after the mortgage crisis era, was to find stuff that was near downtown, that was kind of plighted, and tear it down and build new ones. So we very much got the bug doing that, and we've done, I don't know, about 60 of those projects in and around town over the last 10 years or so. But the real estate market hadn't been real fun here in Austin the last many years. And my life has changed too. So our incomes have gone up quite a bit, my wife and I. And I've been going to the same real estate meetup for, I don't know, at least 10 years here in town. And I don't know, probably about 3 years ago, an oil and gas broker stood up in the middle of the meeting and said, who here has a really high active taxable income problem?
Right.
And I was like, well, that sounds, so my ears perked up because I've been constantly looking for active tax deductions or losses against our active tax income. And for any of the real estate investors out there, that they'll probably understand this, but it's great to get deductions from real estate, but they get suspended if you're not a real estate professional. So you can only take them against active losses. I'm sorry, passive losses, or passive income. Passive losses go with passive income. So that very much caught my attention, and we started talking, and I learned all about this really cool thing called an intangible drilling cost, or an IDC, which is something that if projects are set up the right way in the oil and gas space, it allows you to deduct almost 100 cents on the dollar of your investment against your active taxable income in year one. Which is great. So we've done, I think my wife and I have done 7 of these projects. The operator that we're dealing with has been really good. He's been doing this for like 35 years. So he's probably forgotten more than I'll ever know in the space. But are very intentional about how we do our deals too. So we really wanted to invest our money and make sure that these guys did what they said they were going to do for some period of time before we decided to open it up. And my background's very much raising and organizing money. So this is going to be we just started our 3rd private equity fund. It's called the Texas Freedom Fund. And we're sharing a lot of what we've learned on these deals with investors and the capacity to invest. One of the downsides of these investments is that just the way that they're structured generally with the cost of setting everything up, it's usually like a $250,000 buy-in to get into these deals. But we've designed ours very specifically where people could invest as little as $25,000 to get in. So
Wow.
that's what we've been working on the last several years. And we don't even have a website set up yet. We're just kind of, there's so much inbound. We're selling it kind of passively that haven't really needed to set all that up. But that's our big passion project right now. It's taking up a lot of our time.
Gotcha. I want to go back to, you talking about the oil and gas and how it's active income or active loss. With that, yes, I mean, great tax break with that, for what you're investing in. But then what kind of return on, your investment are you getting outside of, the tax break? Not that the tax break isn't good,
Right.
because that's, if you're in the
Yeah, no,
40%
I'm
tax bracket,
completely
that's
with
pretty
you.
good. Yeah.
Yeah, completely with you. So the goal of any investment should be maximizing after tax income or gain and not minimizing taxes. So we should start there. But yeah, to answer your question, they're usually structured where you put your money in, and if oil does what it should do and stays in the $60 to $90 barrel range, which there's a lot of interest on Earth that have, you know, a lot of reasons to try and keep it in that range. The deals tend to return capital in about 3 years. So, you put your money in, you should get all of your money back in about 3 years. Now, if oil's a little, if it's less, it might be 4 or 5 years, and a lot of the returns for the deals tend to come in the first several years because there's depletion for the deals. But then after that, they're nice steady income, and they usually deliver on the order of like 1.5% or so cash on cash returns per month. So you can think about maybe 18% annualized. But I'll let everybody do the math on the internal rate of return calculation, but it should be north of 30 for most deals. Now, obviously any deal comes with risk. So there's lots of risk involved in these deals too. So it's only for accredited investors the way we have everything set up. Um, but the biggest risk, honestly, is the price of oil and gas. With all the technology, the way that it's fashioned now, and with all the railroad commission data, you're able to see what all of the fields around you have done, just given how they're set up. And I tell everybody I use the soda straw analogy. I don't know if you've ever seen There Will Be Blood, and he puts
Yeah.
his soda straw on the ground and I drink your milkshake. Well, the deals used to be you put a soda straw on the ground like this, and you root around and you try and find oil, right? Well, with all the technology the way that it's been for a while now, what happens is the soda straw goes in the ground, but it turns sideways and it goes through a giant shale formation. And not only that, it opens up into multiple wells, right? And then all the wells end up having this fracking fluid, and they blow the big holes in them and they suck the oil out. So I tell everybody, if you got a giant shale formation and you're, digging a soda straw through it sideways and you blow it up and you suck oil out, I guess you could screw that up if you really tried hard, but if you got multiple chances at it, it's kind of hard to screw it up. So the biggest risk isn't honestly not finding oil; it's really more the price of oil after it comes out, and that's subject to all sorts of forces on Earth. It's a global market for sure. The other thing I'll say is that I am a big believer that the price of energy is going to go up. There's a growing middle class in China and India and some of the most populous countries on earth. And all those people want all the same things we have here in the States. They want nice cars. They want, refrigerators and things like that. So that's driving a lot of demand. But really, the big one right now that we're really sort of start in the early stages of as the artificial intelligence boom, right? And so there's a big reason that very smart money companies like Microsoft are putting their data centers right next to 3 Mile Island and places like that, nuclear facilities, because they're seeing, 5, 10 years down the road what the bottlenecks and constraints are going to be in terms of growth. So I'm very bullish on the price of energy. Um, That's not to say that it's going to be a straight line up. It might be choppy along the way. So the deal timing matters a lot. Nobody should get into these sorts of opportunities thinking that they're get rich quick. They definitely take some time to play out. It takes 4 to 6 months to drill the hole in the ground and to get everything operational. So there's some lag time too. But I kind of like to think of them almost like a bond laddering strategy, right? Like you get into one, you get the tax benefit, you get some money coming back, that some period of time after that. Once you get a certain amount of your money back, you go put it into another one. You get another tax benefit, and the process should repeat.
Right.
And so that's the way that we're investing right now. We're very much laddering up all of our investments to do the same thing.
Now, in talking about this, what are some of the mistakes that you see that people are making? And I'm going to call this an alternative investment because I don't look at it, I mean, it's not the market per se. What are some of the common mistakes that you see people make when they're trying to get into these alternative investments?
Well, just broadly, alternative investments that's really what I've been doing for like 20 years now. A lot of the stuff has been in real estate. I think the biggest mistake is not understanding what you're investing in well. So are you investing in a working interest in a well? Are you investing in a securities interest that invests in a working interest in a well? What does that mean? Why is it important? Those sorts of things. So that's kind of like if you think about the jockey and the horse metaphor, it's like, learning, how good the horse is. Is the horse a good horse to bet on? But the jockey is equally as important, and probably more so, especially in the alternative investment space. There's a lot of things that, alternative investments are really, riskier. They tend to be or can be, depending
Right.
on how they're structured. But there's a lot of liquidity risk. So if you put your money on, there's not really an easy way to go trade it on the secondary market. So you need to be mindful of that, like sort of the duration of your investment. And most people understand that, but I think what people don't do a great job with in the space is really, you should invest with people like, and trust. And what's the character of the person you're investing with? Have they been through a bunch of market cycles? Or did they just start and that, everything's a run up at that point, and so everybody looks like a genius in a run up. So, anybody that's been around long enough doing these sorts of investments, 20 or so years, is going to been through a bad period too. And how did that person perform in that bad period? Were they able to weather through it? Did they have the liquidity and staying power to do it? Or are they still communicating with their investors? Can you talk to some of those investors and talk to them about their experience? I think those are all important things to understand because the wisdom and experience of the sponsor, the deal sponsor, really matters a lot for these sorts of opportunities.
So if somebody wants to get into this and you're saying it's like, hey, obviously you want to deal with somebody who's done this multiple times and really understands it, how can someone who wants to get into that, how can they find out if, hey, Bryan says he's done this a bunch of times and he's bringing it to me. How can I find out if what Bryan's telling me is really true with their background?
Yeah, I mean, ask for some accounting of their track record. So that's one thing. Believe it or not, this is going to be kind of a crazy answer, but I pretty much live on Chat GPT and Gemini and Grok AI now. And you don't even really have to be like the smartest investor in the world. You just have to know what good, sort of leading questions to ask it and say, you could even do something as simple as take the role of a leading, alternative investments advisor. What questions should I ask? And you let it interview you, right? And then I think if you do, an hour session with it like that, you can come up with a really good list of questions to ask the person you're going to be doing business with. And then, just try to get real comfortable with the answers that they give you and make sure that it seems like they've done their diligence to set things up the right way. They've thought about risk a whole lot because there are risks, very real risk in any of these deals. And anybody that tells you that they're not, you probably shouldn't be doing business with. So, that would be where I kind of would tend to steer people. If you asked me the same question 3 years ago, I probably would have given you a different answer. But it's just we have an embarrassment of riches with tool sets now that people just largely aren't using. And I think that would be a really good place to start.
Yeah. I mean, many people, especially when they're getting into an investment side that they're not used to dealing with and have never done, kind of the Bernie Madoffs of the world kind of come
Right.
back in your head, and it's like, okay, you know, in the alternative investment, field, is there a regulating body or anything else that you have to deal with that somebody can look up your record, look to see if you have any
Right.
complaints or anything else? Is there something like that out there?
It depends on how the investment that you're investing in is structured. There are a lot of people that have a more traditional broker dealer setup to be, and that tends to be with people that are moving greater quantities of securities. So raising more money for bigger types of deals. The sort of investments that we're talking about tend to be kind of like the syndicator investments. So they're really too big for the really small investors, but they're too small for the really big institutional investors. And that's kind of like a sweet spot for where you can find really skilled operators or sponsors, but they are not going to have all of that regulatory burden from FINRA and things like that. And a lot of folks like me included would love to have all of that, but it comes with a cost, right? Like none of that stuff is free. So there's trade-offs, right? And like anything in investing or finance, risk and reward just go together. They just do. So if somebody's showing you something that's got 30% return on investment, well, yeah, it's going to probably tend to be a little bit more volatile, and it's also going to probably tend to be a little bit more susceptible to some sort of like big shock risk, right? Like especially for real estate in Austin in the last several years. I mean, the Fed raised interest rates 11 straight times,
Right.
over a course of a very short period of time. Well, purchase money for mortgages went through the roof. Well, when that happens, well, guess what happens to all the prices of real estate? They go down. So it doesn't matter how skillful you are as an operator. If prices go down 30%, there's going to be pain all around, right? So those are all things that should be disclosed properly in private placements. Um, One of the things that people can do, that's really it's the nature of building a relationship with a sponsor or an operator over time too, is what's their buy-in amount? You know, can you buy in for a small amount and kind of try things out? Because I mean, they can sell you really well, and everything looks great in Excel, and everything looks good on a perspective or on a slick that they send you. But a lot of times, it's not until you get into a deal and you see how it's actually operating that you really learn a lot. And so that's why we very purposefully try to design our investments with a really low buy-in too, because we're long-term greedy. We're really trying to design something where we can get lots of new relationships, and then our bet is that we're going to do what we say we're going to do, and that person's going to want to re-up with a bigger investment on the next opportunity or later on in the fund's life cycle. And that's just generally how relationships are grown if they're grown properly. Banks do this too. If you ever go to a bank, they're not going to just loan you, $10 million right out of the gate. Generally, unless you're worth $100 million, then it's probably pretty easy. And you probably don't need the bank. But what they tend to do is they want to grow a relationship, right? Let's do one. Let's do a small one. See how it goes. See, do we know, like, and trust each other? I can tell you, having been doing all sorts of crazy real estate stuff and private ventures and things like that over the course of 20 years, there's nothing worse than being in a bad partnership, right?
Right.
Being in something that you wish that you had just kind of started slower. So I kind of think of it almost like dating too. You got to date before you become boyfriend, girlfriend, and you got to, become boyfriend, girlfriend before you get married and have a family, right? So just kind of think about in those terms and, grow the relationship slowly. I think anybody that's coming out of the gate, it's like, hey, you got to invest some giant amount of money right out of the gate. They're either lazy or they're not really wanting to foster a long-term relationship, or, there might be something kind of, not so good going on in that transaction. So that's just generally how I think about this. We've been doing it for a long time, and there's really no shortcuts to success. You just have to put in the work.
Right. So tell us more about the Texas Freedom Fund and why is it that you decided to start this up and what are the requirements and what do people need to do if they want to learn anything about this?
Yeah, so Texas Freedom Fund is brand new. We just set up the entities. I think we're recording this in July of 2025. We set them up maybe a month ago. We have a couple of investors in the fund so far, so we're very much still in our growing stage. It's set up right now as a special purpose vehicle, so it's deal by deal. We have two classes of securities. One is for people who want to just do one investment, and the other one is for people who want to re-up their investment in future deals, more in a fund-like manner. And that's done through what are called successor funds. So you would be opting into a specific class of securities for that. And you have to agree to do at least one more deal. But that's really who we're after, folks that are looking to get those tax benefits we are talking about, are comfortable with the risk, and really are after some nice steady stream of income after they invest. So that's why we've called it the Texas Freedom Fund, is it's really a path to financial freedom. Now that doesn't come overnight, right? But it's freedom from taxes. And it's also freedom from needing that paycheck day to day, right? If you have enough dollars to invest. It generally, somebody in the tax brackets that we're targeting, they invest in three deals. The fourth one generally is paid for in the tax benefits from the first three. But that's what it's for, is it's investing in fracking projects in the Eagle Ford Shale and the Permian Basin. And we have been doing a lot of work over the last many years to cultivate relationships with best-in-class operators that have been doing this for over 30 years. So that's a lot of what you're getting by investing, is just all of that work, trying to find the best possible operators, and then also all of the work to structure the offering where it's a lower buy-in, and it's something that really will allow you to design yourself out of you know, your working situation if that's what you got going on, or just to be able to supplement your income with some nice passive mailbox money.
Gotcha. So, Ryan, we covered a lot of stuff quickly here. What have I not asked you wish I had?
I don't know. We covered a lot, but I think that you know, I where you really probably should start a lot of these conversations is like, what legacy are you trying to design for yourself, right? Like, sort of start with the end in mind. So I think that, to the degree this is mostly a financial conversation, you can't ever have a financial conversation in isolation. It's like you need to start with your goals. So I think that that's probably what folks should think about if this is the right opportunity for them, is like, what are your end goals? What do you really have a clear picture of what your legacy is and what you're trying to build? Are you really trying to figure out how to live life on purpose, right? So that's really the investors that we're after, are people that either have that vision or they want to work with somebody that can help them on the path to that vision. So I think that's probably maybe something you could have asked about to start with. And financial conversation should start with your life conversation and what life are you trying to design.
Right, right. Um, what if people want to learn more about, about Bryan and about the Texas Freedom Fund and integrity and development? How can they find you? How can they reach out to you and learn more?
Yeah, we actually don't even have a website set up for the fund yet. So the best way to get me right now is just to connect with me on LinkedIn. I'm Bryan Hancock with a Y, Bryan Hancock, and just send me a DM with the word freedom in it. We can have a nice conversation.
Great. Bryan, I really appreciate your time today. I look forward to learning more about the Texas Freedom Fund and seeing the people that you guys help.
All right. Thanks so much. I appreciate you having me on.
Great. Hey, this week my guest was Bryan Hancock, and he is the founder of the Texas Freedom Fund, and I'll see you guys next week.